Well, perfect. We're recording and live. Ladies and gentlemen, thanks so much for taking the time this Monday afternoon to join us for this very exciting webinar that we have on the state of the crypto derivatives market. And we have folks from across the gamut, if you will, to join us to unpack some of the trends that they see shaping what is a very important and fast-growing corner of the crypto market. So before we begin, I guess we can do a bit of introductions. I'm Frank Chaparro, editor-at-large at The Block, and then we can just go around the horn here, maybe starting with Tim McCourt at CME, and we can give a little rundown about our respective roles, what we do, and how our firms fit into the landscape.
Great. Thanks, Frank. So Tim McCourt, Global Head of Financial Products and OTC Products here at the CME Group. And in terms of cryptocurrency and where we fit in, we offer regulated futures and options on futures for cryptocurrency, mainly on the Bitcoin and Ether offerings within the broader cryptocurrency ecosystem. We first launched our products in 2017 and expanded over the years. And we also offer a suite of reference rate and real-time indices with our partner CF Benchmarks, which are also regulated benchmarks with respect to the indices and reference rates that we provide.
Great. Thanks, Tim. Jonathan?
Yeah. Hi, Jonathan Chan here, Global Head of Business Development and Partnerships at Wintermute. Wintermute is a crypto-native, high-frequency trading firm that trades billions of dollars worth of crypto assets every single day across centralized and decentralized venues. Wintermute's principal OTC desk trades over 200 assets across spot and derivatives as well, which includes options, CFDs, and structured products. Happy to be here and excited to be on this panel.
Thanks, Jonathan. George?
Hey guys, my name is George. I am the COO for DYDX. DYDX is the largest decentralized exchange for crypto derivatives. We focus a lot on perps, and excited to be here and a part of this conversation.
Thank you, George. Chantel.
Hi, my name's Chantal Bradford. I work at Deribit. I cover EMEA sales. We are a crypto derivatives exchange specializing in futures and options. So we're the sixth biggest derivatives exchange overall, but indisputably the number one in options with over 90% market share.
Fantastic. Thanks for joining us. So let's sort of do some level setting. Obviously, 2022 was a wild year in which we saw a credit crunch that sort of knocked out a lot of key infrastructure and market participants in the crypto space. How has that impacted derivatives? Have we seen sort of the action shift to different types of venues, to specific types of products? What does that look like maybe from your vantage point, Jonathan?
Yeah, no, that's a good question to start off with. Crypto markets kind of echo traditional markets as well. When there's some sort of special event that occurs, volatility increases and volumes increase as well. And this ties into the fact that a lot of participants want to trade off these news events. And a lot of sophisticated participants want to participate in these trades by using derivatives to either hedge or speculate. And what we've seen in the latter part of 2022 and the first part of 2023 is the increase in volumes in derivatives, whether that's on venue or via OTC as well. And that goes across all the gambit of derivatives that we are talking about today, whether that's CFDs, options, or perpetuals and futures as well. So it's a pretty positive sign where the market has turned to leading more growth into the derivatives markets for the past 6 months. And that's what we've noticed at Wintermute.
There's obviously a big question of where did everyone go after the meltdown of FTX? They were a fairly large player in derivatives, specifically in perpetual swaps, similar to Binance and other offshore venues. Not the biggest. A lot of people can, erroneously think that they were the largest. I'd say maybe their market share at Pico Top was something like 24% in futures, somewhere around that ballpark. So where did they go? Where did the interest shift? Obviously, it was somewhat of a tailwind for CME, and I'm sure to an extent, Tim, you have sort of reveled in the newfound activity. And it makes me think of a conversation we had in 2019 where a lot of these new players were cropping up, and I maybe prodded you about the extent to which some of these new players were eating your lunch, and now it looks like the steak and potatoes have been passed across the table to you.
Yeah, I think when we look at some of the events at the end of last year, and then maybe even coupled with some of the price rally that we're seeing this year, we are seeing certain themes being reinforced. And certainly at CME, it's that, being the regulated venue, being the trusted venue, offering the centralized clearing where we guarantee every trade on the exchange. These are facets that people understand in other aspects of the financial ecosystem and are just being re-honed in on with respect to cryptocurrency. When we look at November of last year, we had our largest single day trading record volume of over 207,000 contracts across the cryptocurrency products that we offer here at CME. We've also seen increased number of account openings as we look at sort of December, January into Q1 here. We've seen above average account openings. So that would suggest that people are certainly turning towards the quality of offering at CME in the light of some of the events that we've seen. But I think when we look at other comments and other panelists on here, like what Jonathan was saying, is they're not just turning to CME. We're seeing sort of this interrelatedness between the various types of products, whether it's OTC, options, futures, swaps, forwards, perpetuals. I think people in general are turning to many more places because they also realize outside of the regulated venue like CME, it's important to be diversified in terms of where you are accessing the market and how you are managing risk. And I think what we've seen even here in Q1, that not just with respect to crypto, but I think when we look through this, the crypto only lens, risk management needs are continuing to increase. And risk management is becoming more and more important as people look to figure out what is on the horizon. Certainly the price appreciation we've seen, certainly some of the other events, whether in the banking sector or the crypto sector, there are emerging risks that present themselves, and manage your risk is ever more important. You could do it at a centralized regulated venue at CME, or you have to sort of choose your partners and platforms wisely if you're looking into some of the unregulated offerings out there.
So as this desire for more risk management solutions increases, Chantal, how does Deribit meet the needs of those clients?
Well, I think sort of towards November we had also one of our best trading days ever, and obviously with the collapse of FTX, there was a lot of volatility, and then we went on to December, and it was awful. Like volatility reached all-time lows. A lot of people took money off exchanges. People were going onto the CME. I think people were looking elsewhere. But obviously with kind of the price rally in January and February, and then obviously the banking crisis in March, people have started to come back. We've had record trading days. So we had BTC in March, number of contracts, the highest we've ever seen traded. Our open interest reached over 20 billion for the second time ever. But this time BTC is half the price. So a lot of people are coming back. I think, again, like with, Deribit as an exchange is starting to get regulated, so we're applying for our VARA license in Dubai. After that, we'll be getting broker licenses in Europe. And so I think we've built up a sort of position of trust over the first 2 years. We've done a lot of initiatives that, we've always put customers first, sometimes to the detriment of the company. When we had our problems with 3 Arrows last year, when we got hacked, again, it was all paid after company funds. So I think it takes a bit of time to build up that trust, and which is why I think that people are thinking a bit more about what exchanges to trade on. I think it will be harder for the new exchanges to break into the market. But I do see that, OTC, CME, LCH, who last week announced that they were going to start clearing crypto as well, are going to start breaking into the market and growing the market overall.
And if you sort of juxtapose the centralized crypto venues working towards instilling more faith in their systems, maybe rolling out different types of risk management solutions, making their platform more robust, in the wake of what was a year in which we saw a lack of transparency, a lack of trust. How do you juxtapose that, maybe, George, with the option that a DYDX, a decentralized exchange, provides? There's not that same opaqueness. It's almost like the centralized players are trying to become more opaque, but that's something that's basically already there with a DEX. How do you sort of think about the competitive forces there?
Yeah, great question, Frank. Over the course of 2022, I believe in decentralization more than ever. There's this whole sort of ethos in crypto Twitter about the prospect of not your keys, not your crypto. And, you know, post FTX kind of collapse, I think that narrative really hit home for a lot of folks. Even think about this a little bit differently, in that, like, I always think that there's going to be a place for centralized exchanges, right? There will always be a place for Coinbase, just like there will always be a place for Uniswap, right? In many different ways, I think that analogy in the crypto derivative world exists for DYDX versus some of the big players like a Binance or Bybit. So you mentioned post-collapse of FTX. What's super interesting is after the collapse of Binance, of FTX, if you look at where the market share went, a decent amount of the market share went to the industry leaders in crypto derivatives. So I think if you look at the January 1st to end of 2022 market share for Binance, it increased significantly to 50% plus or so of the crypto derivative trading volume. Bybit's another centralized exchange that increased significantly. And, you know, from around mid-year or so to end of year, DYDX also saw its market share increase 50, 60, 70% as well, from a much, much smaller number. But I think we do see the winds turning to people caring more about decentralization, people caring more about being able to custody their crypto and protecting themselves against like these tail disasters that can happen, right? You can trust different sort of custody programs, or you can just actually look at open source code. And the open source code is there for anyone to scrutinize, and certainly can give a lot of people a certain level of comfort that they can't otherwise have.
Is there a way to sort of marry the two together so that you have a centralized matching engine or interface that leverages the transparency of blockchain so that you can see exactly that the funds or the collateral are locked up and not maybe being rehypothecated again and again and again, or used with a letter that just says "Love Kyle Davies" on it? How can you sort of marry the two so that there's even more trust?
Yeah, I think it's an excellent question as well. You certainly can have hybrid exchanges where, you know, you have aspects of centralization and you have self-custody wallets, right? I mean, if you look at the development of DYDX, that's the history from which DYDX came from, right? But the reason why we believe the power of decentralization will win in the long term, and if you look at a bunch of decentralized exchanges, like CZ from Binance has mentioned in the future that in the past that he thinks the future is decentralized exchanges, and that's like a big focus for Binance going forward. The reason why I believe that this will be the thing and one of the most important traits of exchanges going forward is because it levers use cases and powers you otherwise wouldn't have access to in crypto. In many different ways, it's the whole point and ethos of crypto, right? I'll give you an example. So Uniswap enables people to actually trade tokens that are otherwise too small for people to really care about trading on in a centralized exchange. And here at DYDX, we see a real superpower you have in the future for a derivatives exchange like DYDX to be able to actually create permissionless markets where people have similarly the ability to decide what kind of markets they want to trade in the future. And I do think that that is like a very, very powerful superpower that, you know, is only unlocked through decentralization.
So Jonathan, everyone's given a good sense of where they fit into the market and how they've seen the market shift over the past, let's call it, year. As a person who trades across, I would imagine, all three of these venues, how has your activity changed? And maybe can you walk us through a specific strategy or trade that might incorporate all three of our fine panelists and how that might look different from, let's say, a year ago?
Yeah. I think the good thing about Wintermute is the fact that we trade on so many different venues across centralized and decentralized venues, right? And the reason why we're able to do that is because, to an extent, we are as large as we are. We are Wintermute, and we've built a trading system and a rebalancing system that we're able to communicate to all different venues that we trade on, right? And that's specific to Wintermute and other large players in this industry. Unfortunately, that's not accessible to everyone, right? Because a true prime broker hasn't been built yet, I guess, to communicate to different venues. This talk, there's one talk for spot, but this talk is specifically for derivatives. In derivatives, it's even more fragmented, right? And echoing what Tim was saying, it is necessary to have a DYDX or a Deribit and a CME as well, because it gives options for market participants to get access to different pools of liquidity across different geographies as well. Going back to what Wintermute has built, we have connected to all these different venues, and we have been able to gain liquidity and pricing from all these different venues so that we're able to effectively provide liquidity, capitalize on the exchange arbitrage opportunities as well, but most importantly, be capital efficient. Just to give an example, because it's options for CME and Deribit, if we're short 100 options on CME and we're long 100 options on Deribit, we have to post collateral on both venues, right? That's very capital inefficient for trading firms and institutions to do. But Wintermute has built this internally where we're able to gauge the system internally and we're able to facilitate these trades so that we can make these large trades across different venues. And then this also ties into DYDX as well, across different products, spot derivatives as well. So it's going back to your question, it's quite difficult for many participants to build this framework like Wintermute has, unless they have a good amount of capital and a good amount of dev work over the course of years that Wintermute has kind of developed.
Understood. So Tim, maybe you can walk us through how CME's product roadmap is sort of shaping up for the year. I know you talked about on our call, kind of digging deeper into ETH as well as Bitcoin and leaning a bit more into the OTC market. Maybe we can talk about how OTC is becoming an increasingly more important component of what we're seeing in options or derivatives overall, and we can get a few other perspectives on that.
Absolutely. So when we look at the crypto market, I think what is interesting compared to, say, some other traditional asset classes is it's almost an inverted product development cycle. And what I mean by that is we look at something like equities, we had sort of the wholesale market of, evolve over time, and then it got brought down to sort of the retail or the individual community. Here we're sort of seeing the opposite in crypto. It's really sort of this upwelling from a lot of individual traders, smaller trading firms, new types of institutions, and now the traditional sort of wholesale community is trying to catch up, which is now why we're also seeing increased attractiveness and interest in sort of the OTC ecosystem. Whether it's options, whether it's forwards. I think these are things that you're hearing more about in some of the media coverage with respect to traditional banks. But you also have crypto native institutions who are now major OTC liquidity providers. They're doing sort of very structured OTC deals. We also are seeing the continued advent of structured products, whether they be ETFs or ETNs, trying to figure out how to bring some of this wholesale product offering, marrying more traditional players with some of the crypto players. And that's what we're seeing too. Just today we announced the expansion of our option maturities at CME, where we'll now be offering option expirations Monday through Friday for more of the traditional week. We also are working to bring things like both executable and cleared NDFs to market over the balance of the quarter here in Q2. And a lot of this is just from customer feedback. They need more tools in their risk management toolkit. And we're trying to, like I said in my opening comments, while we're still sort of focused on the Bitcoin and Ether lanes for product development, because that's where we have the regulatory clarity at present. And we want to maintain sort of offering regulated products on the regulated venue at CME. But that doesn't mean the product innovation stops. It just means we're going to turn to different parts of the ecosystem to bring additional risk management tools, whether that's options, OTC, or continuing to bring out new type of spread trading tools to the marketplace. These are all things we're focused on. But I will echo the comments. If people can help to solve unlocking some of the capital inefficiencies that still exist, I think prime brokers is needed. I think sort of the better we can do to for other participants to figure ways to bring these liquidity pools together, whether it's OTC, options, futures, similar products across different venues, that will also certainly increase the velocity of the market, which will certainly unlock a lot of potential, I think, for the institutional traders out there.
So what is the state of the velocity of the market right now in 2023, where you don't necessarily have a prime broker through which you can trade derivatives and spot side by side in a capital efficient manner. There's a lot of players that have, gone bankrupt or don't exist. There's what everyone's describing or calling the Alameda liquidity gap. I haven't said the word Alameda in a while. I almost got tied up on that one. Is the market less robust? I'm sure people are a bit more weary to trade. So how has that impacted the velocity of the market and the robustness of the market, Chantel?
Well, I think I see a much bigger use of custodians in the market. So I think prior to FTX, I completely agree. We're definitely missing a traditional prime broker with a big balance sheet in the market. In traditional finance, you'll be a member of a clearinghouse, and everything will pretty much be going through that prime broker. But I think, from a crypto perspective, we have custodians. So Deribit, we integrated with Copper about 3 years ago, and Kobo, which is an Asian exchange, currently doing Fireblocks, and Fidelity off exchange at settlement as well. Up until FTX going down, I think, Copper had us and a couple of smaller exchanges connected to them. Now OKX have announced that they're going to connect. Huobi are connecting. Binance have got their own separate custodian, which they're trying to kind of do the similar thing, but get everybody to connect to them. But I think that there will be a much greater use of custodians, because people, I think, for further institutional adoption, I think, you can't have assets sitting on the exchange. You need to sort of have something separate. And so we're starting to see sort of volumes from Copper going up. That said, 90% of trading volume still go directly through Deribit. So 90% of our flow still does come sort of from assets that are sitting on the exchange. But I think as more institutions enter the space, I would see that changing, particularly as it will be kind of, now with the Clearloop offering, you'd be able to trade off exchange with Huobi, Deribit, OKX within a couple of months, and the same with Fireblocks. I think, again, I think it has started to pick up again. I think, again, people don't want to miss out on the volatility. So people have come back, and they sort of stayed away for a little bit, and they have started to come back. You can see we have a partner called Paradigm. So a lot of our block trades go through Paradigm and get executed on Deribit. That sort of is about 37% the last month, and it was, I think, just under 30% in December. So that shows that these big institutions are coming back because they want to be trading in size. I think with the ETH upgrade this month, again, we've sort of, we've seen a slowdown in BTC, but we've seen an uptick in ETH, and maybe next month there's going to be another issue in the banking crisis, so maybe it sort of speeds up again. So I do feel quite sort of positive on what's going on, and from the Deribit perspective, as long as it's volatile, there's lots of trading going on, and so it doesn't matter where which way the price is moving. It's just volatility, and I think, as we all know, every month there's a different type of news which sort of creates this. So I think it will just be interesting. I think a lot of trust with proof of reserves, etc. So all crypto exchanges now are doing proof of reserves. I think a lot of people, of course, that you need an audit. Of course, that's something that needs to happen. But again, sort of proof of reserves is in real time. We do it on a daily basis. So an audit tends to happen sort of 9 months after year end, and so it's very retrospective. So I think that's what everybody needs to do, is to sort of bring back the trust to the industry and grow it that way.
I'm sure this is a bit funny for you, George, if you think about proof of reserves, which is where most of the centralized exchanges are moving towards. This is something that's inherently baked into what a DYDX is. Is there anything, we were talking about the topic of marrying these two worlds together, is there anything that you can bring from what a CME or Deribit might have that is centralized in nature to an extent, or traditional in nature, that can provide tooling on the risk management side for folks using a DYDX?
Absolutely. I think there's a lot to be learned from both worlds, on both sides, right? Like, I actually think one of the things that's holding decentralized exchanges back in general is a lack of good user experiences, a lack of good education, across both like consumers as well as like institutional investors. And in order for DEXs to achieve their vision, essentially of having like worldwide impact on many, many different people, you have to bridge both that user experience as well as that education gap, right? That's, I think, actually one of the most important things for DEXs to work on. I also want to touch on something you said as well, Frank, which I think is super interesting. So even though in the last year or so, spot volume has decreased meaningfully, I actually see crypto derivatives to be doing quite well compared to 2022, right? Not like, dropping at the same rate or by the same amount that that volumes have dropped in spot. And I think it's still interesting that, like, you have exchanges like Uniswap hitting all-time highs and trading volumes above Coinbase. There's some additional market circumstances around why they hit that. But even the fact that they're hitting those records, I think, is pointing to like a general trend you have in terms of like there are more people using and adopting decentralized exchanges and accomplishing things that otherwise would have been difficult to do in a purely centralized way, right? But I think, for decentralized exchanges to be accessed by like a broader swath of the crypto trading world, and DeFi is still used on the order of magnitude of hundreds of thousands of monthly active users per month. Sometimes people forget like how small the number of actually active traders are, but it's on that order of magnitude of hundreds of thousands of users. To go beyond that to the order of magnitude of millions or tens of millions, there's still a lot of just like user experience as well as education gaps that need to be crossed over first.
Interesting. So Jonathan, when you look at sort of the competition here over the next 5 years, what is the breakdown of activity? Chantel mentioned on our prep call that the pie will get larger and Deribit will be okay in a world in which their market share for options is no longer 90%, maybe it's 50%, but the pie is bigger. In a few years, is it CME versus Deribit to sort of win the crown? Where do the DEXs fit in? How do you imagine the landscape looks?
Yeah, I think that the pie will be massive, and everyone will gain more market share. Otherwise, none of us should be
up
here,
only
to the moon, right? Otherwise, why is anyone in this panel right now if we're not in it for the long term? For the near term, I can't really comment.
I'm getting paid to be here.
Fair. For the near term, I can't really comment on. For the long term, but I'm very confident that another 2020, 2021 will come into play where, as I think Tim was mentioning, it was kind of driven by retail, right? But the next big wave that comes into play, the true institutions, which I know everyone here has been saying it for such a long time, but as the true institutions come into play, the pension plans, the RIAs, the large asset managers that put it on their balance sheet, that start to trade to speculate to hedge their underlying position, that next wave is going to be massive. And everyone here is going to be super happy and friends, even though they're competitors, quote unquote, because there's such a large landscape and market share for each person to gobble on. So I'm extremely confident that that the three venues that are on this panel will definitely grow and grow significantly. But there will also be other players as well that kind of I guess sit in a more niche market. But the players here, the people on this panel right now, it's more for the masses, and I'm quite confident that everyone will be quite successful in the long term.
Yeah, I agree with that. I think the one thing I would say, though, Frank, to your question is certainly I view this as sort of a growth versus growth story, right, across the various type of offerings and menus that are out there. But I think the one thing that will change is I think there will be less tolerance for sort of suboptimal offerings. I think some of the things that we've seen over the last few years, the price appreciation, the width of markets, the opportunities for both individuals and institutions to make money in this space sort of forgave a lot of the inefficiencies or sort of suboptimal behavior. And I think the last few quarters, what we've seen is there's a real expense if you sort of pick poorly with respect to how you're managing your resources, how you're managing your assets, or where you're deciding to trade. So I think that will be something to be interesting to watch as it continues to grow. I think it will grow in a more focused manner where market participants entering will be much more careful about the venues they want to interact with or the products they're looking to deploy, where I think that will be a little bit of a different dynamic next few years, say, versus the last 5, just with respect to the tolerance for some of that suboptimal behavior or offerings that were allowed to persist the last few years.
So can you walk us through, I saw a question in the chat, and it's something that a few folks asked me while I was preparing. When you go down the long tail of assets, and we can get Deribit's perspective on this as well, what boxes need to be checked? You walked us through the appetite that there is for a broader range of products around ETH and Bitcoin. Is it simply just that? Is it a threshold of client interest that moves you into a new asset? And how does that process work? I know it kind of starts with the maybe the reference rate, and then you move on from there. But can you give some color on what makes a CME ready to get into a new asset there?
Yeah, it's a great question. I mean, it largely comes down to, and this is not just for cryptocurrency, but across all assets, it's really is listening to customers and making sure that we're solving a clearly articulated risk management need or pain point or an inefficient access point for the market. It really has to address a customer fundamental need. That's a secret to the success of a lot of our product launches. But then when we look at crypto, that certainly holds true, but it's just further coupled with regulatory clarity. That's something that we've chosen to make sure that we're only operating where we have the utmost clarity around the regulatory landscape, because that is a governor in terms of our product introduction. We operate a CFTC regulated designated contract market or futures exchange. So that will be something that is important to us. There needs to be clarity before we move into the other assets. But now, Frank, to your point, we have, I think, almost 50 sort of real-time indices and reference rates that we've launched over the last several years. Now, we are offering financially settled instruments at present. So yes, any sort of additional product would likely need an underlying index or a reference rate, but not necessarily every reference rate we introduce will grow up one day to have a future or options on futures. Some of the things that we're trying to achieve with that is when we look at even other topics addressed here today, there are other things, whether there are contractual arrangements, loan arrangements, commercial agreements. People just benefit from having the transparency of a once-a-day fixing on some of these assets. And we've tried to make sure we've moved from sort of just the traditional major cryptocurrencies to also venturing into things like DeFi, the metaverse. As people are wanting sort of this additional price transparency, we can work with our consistent exchanges to provide that. But I would say at some point, for regulated futures, and even when we look at things like options or swaps or forward or OTC products, there will be sort of a point at which some of these assets just get too small for a derivatives ecosystem. And we see that in other asset classes as well. Some things in equities are great for ETFs, but not great for futures markets. So I think we will see some of that in the crypto ecosystem at some point. But I do think we have a lot of runway to go when we look at sort of the market cap approach for tokens and coins. I don't necessarily think there's one point in that cap table that you could draw a line, but we'll listen to customers and also look to see what we can offer from a regulated standpoint.
Chantel, you want to share your perspective on that?
Yeah, I think so. We're actually about to launch linear options. So our development work has been going into linear options. So up until now, both of our BTC and Ether inverse products. We had Solana. We listed it at a very bad time. That was March last year. We listed it at the end of last year, and so going forward, we'll be launching linear products. But the thing is, I mean, on Deribit, crypto is a 24/7 market, and you don't want to be launching products unless you can get market makers or people to quote, right? So to Tim's point, we want to make sure that it's very much customer driven, and we want to launch products that people are going to be quoting and people are going to be trading. So we're currently exploring which products we're going to list linear on. We're probably going to list sort of 5 or 6. We're never going to be an exchange that has sort of hundreds of coins. I think we're going to have 10 coins, and it's going to be sort of the top layer ones that people are kind of willing to quote. And we are speaking to our clients at the moment to see who will be willing to do that. We launched Devolve Futures last month. So we made we tried to make a bit of a PR thing about it. And but essentially, like the VIX is in traditional markets, the VIX is one of the most traded products in the traditional markets. And so we launched that basically so that people could get exposure to the volatility without having to buy options. And it's very early stages, but we're starting to see sort of growth in that. And I think it's something that people have wanted, and it's an easier way to kind of gain exposure to that without the complication of options. Because again, like I've said previously, I think on the prep call, it's still, options are still such a tiny market. It's sort of between 1% and 3% of spot, and traditional markets, it's about 35 times that, so hugely underrepresented. And what's, I think, really great in terms of sort of the competition in the market growing is that our competitors are not trying to come in and sort of steal our customers. They're actually trying to educate people. So both Binance, both Bybit, CME do huge education courses, and I think it's really important to do that and kind of bring in that education to try and grow the market.
Understood. We need Jonathan to get to work to quote more so we can get more assets listed on different exchanges. You're sitting on your hands there.
I could provide a little more color on asset coverage, specifically from Wintermute side. As I mentioned before, we do trade over 200 different tokens at the moment and provide OTC pricing liquidity on those 200 assets, whether that's spot or derivatives as well. But that is given on our counterparty demand. Because it does take efforts, dev resources, trader resources to set it up on our side. Our algos are set up for primarily more liquid assets, but we're able to price and trade these illiquid assets given that there's demand. And at the moment, yes, we trade on Deribit, and primarily those are BTC and ETH options, but we've gotten a lot of OTC demand from VCs that obviously have invested in some altcoins and need to realize some profits that were locked, some tokens that were locked, or they need to hedge out their underlying that has moved 10x, 20x, 80x, etc. Right? And we're one of the OTC desks, very few OTC desks that are able to provide a price for these smaller coins. And it would be great to have more centralized venues and decentralized venues to list this, because then our pricing would be much more efficient for the end user as well. Just echoing some of the venues here for listings, future listings.
And that's probably driving some of the activity you're seeing OTC. But it's interesting because in crypto, you have venture capitalists who are also, operating in a more liquid world than they would traditionally, which opens up a lot of risk management questions, a lot of or headaches that you typically wouldn't experience in traditional venture capital. How do you hedge these tokens? A lot of people, well, they shouldn't just be holding them, right? They should be trying to hedge or those positions, especially when you see that skyrocketing price appreciation. You've got to take something off the table or hedge it in some way. How have you noticed that? Have you noticed VCs sort of getting a bit more, because that's not their world, right? Necessarily, they don't have an options trading desk, or they wouldn't. But are you seeing them become a bit more active as their hedging needs become more complex?
Yeah, I wouldn't say the hedging has become more complex. It's quite vanilla, but the interesting and unique thing about options and structured products is you could literally come up with an infinite amount of strategies to cater to your hedging or risk management needs, which is very interesting. But that being said, yes, historically speaking, in the crypto world, there's safe with the token warrant. The token adds a premium to the valuations of these new projects, right? And that being said, it is the VC's role to realize some profits for their investors, right? So I wouldn't say that they're not in it for the long term by selling or hedging some of the tokens that have appreciated. They do really need to realize some profits, as it's a fiduciary responsibility of the VCs to capture these profits. And how do they do that, right? If they're locked tokens, then they could do it in the sense of a simple forward, or if it's unlocked its vested tokens, they could sell covered calls as well, or they could protect the price of the asset by by buying puts as well. So they're pretty simple strategies, and we've definitely seen an increase in interest from VCs, individual investors, angels and investors as well, because to an extent, the price doesn't always go up, right? As we saw in 2022, the prices can retrace, and people need to implement some risk management trading strategies to capture and realize those profits.
But while the merry-go-round is going, you got to stay on.
Just double down and buy more calls.
Yeah, exactly. That's the name of the game.
No.
So, George, we've been talking a bit, or we've touched on the evolution of structured products in this market. Back in those more heady days of, let's call it 2021, there were a number of projects that came to me shilling or peddling their DeFi version of different structured products. There was one project that was building out a credit default swap, a decentralized credit default swap. How do you see structured products evolving in DeFi? Is that something that a DYDX can offer? Is it something that you've thought about?
Yeah, we think a lot about kind of what is the future of, both DYDX as well as the evolution of DeFi, right? And I take it back to thinking, how do you think about solving this problem from the perspective of an entrepreneur building any kind of new product, right? Well, the first thing is you want to make sure you have a really, really strong team capable of building the future that you envision, right? But for that future that you envision, a lot of it goes back to kind of really understanding both the persona, the job to be done, the user journeys. I think of this concept of being able to have good product sense is being able to reverse engineer the minds of your users at scale, right? And that's something that we really, really try to do. And in crypto, it's really important to also think about what are the things that crypto is uniquely situated to be able to do better than other industries that existed before. For example, I think you can't do a straight porting of TradFi products into crypto one-to-one without taking into account the unique things that crypto is able to do. So I mentioned one of the things that we believe is that crypto enables the creation of user-generated value that we believe in, similar to kind of how many different versions of Web2 enable the creation of user-generated content, UGC, right? That's what led to the rise of the TripAdvisors, the Facebooks, Instagrams. We think there's something in that realm that's super, super powerful for crypto and the next generation of products. I mentioned this idea of permissionless markets that we're pretty excited about, right? That is the idea and view that in the future, traders would be able to actually help decide what products that they want traded on DYDX by being able to both vote as well as essentially get these markets started themselves. We think that's very, very powerful. We think that's something that's uniquely enabled by crypto. We think it essentially feeds into the thesis of user-generated value, and that is the general direction that we're going in for our product roadmap, instead of, let's say, straight porting of TradFi products into crypto.
Understood. You can't just shove the square into the circular hole, a square peg into a circular hole. It's not necessarily always one for one. I guess we can take a look at what some of the listeners and participants are asking. I'm just going through here because we do have about 15 minutes left. I do want to get some questions from the peanut gallery, as it were. Let's see. Yeah. So if you have any questions, feel free to bring them in. From Ben in the chat, how does the CFTC lawsuit against Binance, specifically rules targeted towards UBOs, impact non-US licensed venues? Is that something you've given much thought to, Chantel?
Well, we don't allow any trading from the US, so that we don't allow any trading from the US, and some of the what I've read in the news, that's just not something. So we very clearly state that there's no trading from the US, and all trading has to happen outside of the US. And if there's a director in the US, they have to sign a form saying that they have no influence or any control over any trading activity.
I guess broadly, yeah, go ahead, John.
Can I touch base on this? Yeah. So speaking on that for Binance and for other off venue or off US trading venues, it seems that a lot of US companies have set up offshore accounts to gain access to trading on these venues, right? Whether that's on Binance or another international exchange, and then but also Coinbase, Gemini, Kraken setting up offshore venues as well to start their perps and derivatives exchange. And I'm quite certain that other US venues are going to set up offshore entities to trade there. Why is that so? Because clearly there's a demand for it, right? So until there's full US regulatory clarity, I don't think that's going to circle back until we get something. And I think the US government should definitely take note in this, that there's a definite demand for it. So they should definitely prioritize this from that standpoint.
Yeah, I think the one thing I would add, though, is that I think this is also something where, depending if we're talking about spot versus derivatives, there's also different frameworks at play, right? So I think one thing from our perspective, we've always viewed regulation as a feature and not a bug. That's certainly been a central tenet to our offering. The CFTC is our primary regulator for our cryptocurrency products at CME. But I think it's also worth denoting, even though we are U.S. regulated in a U.S. futures market, we have global participation. We have people accessing our markets from over 130, I think, countries at present for cryptocurrency. And the CFTC, as a regulatory framework, also offers a way for non-U.S. regulated markets to market and sell into the U.S. So I think there is a clear-cut framework for those institutions that want to operate in the regulated landscape from a global perspective. I just think these recent actions, which I'm not privy to the details, are just shining lights on certain platforms, certain offerings, whether it's spot, derivatives, and that. So we always have to make sure we understand the details, but also just want to clarify that even the U.S. regulatory regime that we operate under is a way to bring these products to global participants.
Understood. I'm sure there are quite a number of folks listening in who are holders of crypto or benefit from the upward trajectory of token prices to some extent. So maybe I'd be remiss not to ask if there's any sort of indication from derivatives. Is there anything that we can glean from the state of the market right now or the activities on various venues that give a sense about the health and, from a price perspective, I guess, direction the market is heading in? That's what most people want to know. Am I going to be wealthier in the future?
Wintermute is a market neutral trading firm, so we're agnostic on the price direction of the digital assets. So I can't comment on the price action of cryptocurrencies.
Yeah, I think when we look at the derivatives market more broadly, there's always been sort of a leading price indicator that can form. There's term structure that exists with futures and options, right? And you certainly see that, I think, on other platforms like Deribit as well. So there's certainly informational value that can be gleaned from the derivatives market that may inform some forward expectation of price. I think what's interesting, though, is that when we look at it, it's really around some of that price formation, how customers are using it. And I think those people that prefer to either be unidirectional, whether they're long and strong or shorting the market, just encourage people to please hedge, right? You don't need to ride out that position. That's where derivatives are a great complement to the spot market. If you want to hold that digital asset, if you want to hold that inventory, you can use derivatives as a way to trim some of that exposure if there's certain episodic events occurring in the market. You don't always need to be long and strong. It's okay to hedge with futures or options.
People weren't hedging.
No.
I feel like I was the only one hedging last year.
Only two things I'd add is just that, if you look at overall volume of crypto derivatives and futures, they continue to be strong. and I'd say that they're strong relative to spot, right? So I think that there's clearly both trading happening as well as interest. As a product, I believe like futures have like strong product market fit in terms of like the functions that they, serve, whether it's some kind of hedging, profit realization, or like, levered investments. So, like Jonathan, I want to be wary about like ever making any kind of public commentary on any specific token. But I believe as like an entrepreneur or as an entrepreneurial-minded sort of builder, I think the products themselves serve a strong purpose. The momentum behind them, in terms of like overall trading volume, have been great. So, I think the overall industry, like Jonathan had mentioned earlier as well, I think has a lot of potential, and I hope and I believe that all the different sort of trading venues on this podcast will continue to grow over time.
I would just add that I think obviously the market sometimes gets it wrong. So if you look at in the lead up to the ETH merge, the put call ratio was sort of 0.2, and so everybody was expecting there to be a massive upside in ETH, which never happened. And then with the Shanghai upgrade, I think people were more expecting there were sort of more, I think, call options that were being put options that were being bought, and now there's been a rally, and now you can see a lot of call options, so the put call ratio is a lot more skewed towards calls. So yeah, I think, you can look at options market particularly and look at what people are expecting. But I think, there was a lot of excitement over the ETH merge, which didn't happen. And now we're sort of seeing the flip side, I think, with the Shanghai upgrade, which is interesting.
If we look at, we have a great chart on our dashboard that shows the number of large open interest holders of CME Bitcoin futures. That's never really slowed down. It basically continues to march upwards and to the right. Where are these? What does that sort of say about the market? Everyone is wondering about, or has been asking, when institutions for a long time, are they already here effectively? And is that safe to say that they're here?
I could start off really quick. I don't think so. Some of them are, but a majority of them are not. And echoing to what I said in my previous comment, when those true institutions come and put cryptocurrencies on their balance sheet, that's when we'll see a titration point with price appreciation. I think what's happened in 2022, as a result of the result of 2021, they wanted to be educated, and they're very, very close of putting it on their balance sheet and actively trading it. But unfortunately, what happened with FTX and 3AC, et cetera, it's kind of put institutions a couple steps back. So we're still, I think, on the education phase, and until they get a little bit more comfortable, I don't think that a vast majority of true institutions with true wealth are in the game yet.
Yeah, I think the one thing I would say around that, though, and Frank, you've heard me talk about this before, I think what Jonathan says is largely true for what we mean by the traditional definition of institutions, right? So think asset managers, insurance companies, banks, right? Sort of these large TradFi traditional institutions. Slowly, we're seeing some of that flow come in largely through the futures-based ETFs. I think is a great proxy, seeing those grow. We're seeing some product filings for sort of outside the 1X, right? We're getting into some of maybe the 2X product designs that people are trying to get approved. But what I've said too is when we look at things like large open interest holder is, even though some of those traditional institutions haven't taken those final steps to deploying their strategies, we at least have seen new institutions or institutional like flows happening. We've seen a lot of systematic hedge funds. We've seen sort of traditional players leave traditional firms to go to some more crypto native or some of the crypto investment firms. So we're seeing institutional like flow. And I think that's what's certainly driving that lower left to upward right trend in large open interest holder, where we hit a record in Bitcoin of about 122 large open interest holders just about 3 weeks ago. And beginning of the year, we hit, I think, 79 or 80 large traders in ETH. So those are all great to see. But I think it's more I would describe the personality of that flow is institutional like, but we're still waiting and working with some of those large traditional institutions to come in. I think you need to discern some of that. Is you can have some of that institutional style flow, even if the large institutions themselves that we're familiar with by name are still figuring it out.
Understood. Yeah, Chantel, go ahead.
No, I was just going to say, I think that they're definitely showing an interest. So they're skirting around the sidelines, and I think in quite a lot of the firms, we get very excited that a big hedge fund is sort of got a crypto desk, and actually I think quite a lot of the time it's to stop people from leaving. So they don't want to leave really good people. So essentially they set up a sort of small crypto desk, and they can kind of have a bit of a play around, and then quite a lot of the time they're doing it alongside their current job. So it is nice, and I think again, I think some of the traditional guys have opened sort of small desks because they want to know what's going on. So it's just that they want to understand it, they want to be able to talk about it. But I think for the proper institutions, particularly given what happened, I think we are a couple of years away.
Fantastic. Well, I guess we can leave it there. I really appreciate everyone taking the time, unless, George, maybe you have some final thoughts on institutional DeFi derivatives use. It's probably a bit even more out in terms of the timeline.
Yeah, sure. I don't profess to know exactly when institutional adoption will happen, but like Thanos, I think it's inevitable. And the reason's because I think if you just look upstream from institutional adoption, which is where are things being built that have value? Where is venture capital funding happening for smart developers building companies and products in the future? I see a ton of it at the seed, Series A, et cetera level. Inevitably, that will lead to a lot of products and companies and protocols and values created at that stage. And at some point in time, the economic force behind it becomes so powerful that institutions can't help but, need to be involved, right? So I don't profess to know when that timeline will be, but I do believe the economic engine at the entrepreneur, developer, venture capital level is very, very strong. And that will lead to this inevitable participation by institutions at some point in time.
Fantastic. Well, thank you all for joining me today, and hopefully we'll see you soon. Do a follow-up at some point.
Great. Thank you.
Thank you.
Thanks, everyone. Thanks for
Thank you,
joining.
guys.